Welcome to the Well-Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Thank you for tuning in. This is another episode of the Well-Off Podcast, where today I interviewed Mike Rockall and Mark Baltazar. They are multi-unit investors that specialize in apartment buildings. And on this episode, we talked about why Mike is still driven to work after so many years of investing, even though he's got assets, he's got cash flow. What is it that makes him want to continue working? We also talked about buying value-add properties where they negatively cash flow off the bat and what some of the things they're able to do to convert them into these positively cash flowing assets. We talked about setting expectations around turning units over. Sometimes when you buy a building, you might want or expect that you're going to be able to turn over a bunch of the units, but that may not always be the case. So you have to account for these things. And then we talked about the renovations that they put into their units, why they're spending 40 grand to renovate their units rather than 20 grand like some other people are doing. What does that lead to in terms of rent? And we talked about separating meters. So does it make sense to work on separate gas meters, water meters, and hydro meters? They give you their take on that. And then finally, we discussed staying up to date on financing options, commercial financing options. There are some pretty cool products out there, so we kind of touched on that a little bit. I know you guys are going to enjoy this episode, and if you do, I hope you'll share it with somebody who will benefit from the information. Make sure to leave us a review on the Apple Podcast platform, and if you want to connect with me, there is a bunch of information on welloff.ca. I appreciate you guys supporting this and tuning in every week, and I know you will have a successful investment future if you continue to absorb information. Enjoy the episode. Okay, I'm here with Mark Baltazar and Mike Rockall, who are first-time guests on the show. It's great to have you guys here. You have your own podcast, and I know you guys are into multi-units for the most part. So I know Mark's been on the show before, but Mike, this is your first time. Do you want to tell us a little bit about yourself?
Yeah, I'll dive right into it. So at a young age, 17, 18 years old, I always used to think if my parents had bought one other property, where would they be now, 25 years later? So there was a lot of interest in investing in real estate from an early age. Didn't know if I wanted to flip houses, invest long-term, didn't know much about it, but knew that it was something that interested me. So I got into construction background, became a licensed plumber early on, and I believe at 24 bought my first triplex. Now, didn't know much about it, was just starting off, and I was actually the guy who gave my money to an expert and kind of learned through their expertise. And then on the second one, dove into it with a partner, but we were the active partners, the hands-on guys. I think we got up to about 42 units and kind of was capping out from a mortgage standpoint. Mm-hmm. So started looking into multifamily. In 2014, bought my first multifamily apartment building and kind of went from there into the multis.
Nice. So how did you guys get together? Because I know you guys work together on certain things. How did this relationship happen?
So we collab. So it was a mutual friend. So I was doing flips before multifamily, had done a bunch of flips, and so my partner on the flips was friends with Mike, and then we collaborated. I forget actually how it happened, but we collaborated on a flip. And so it was the three of us, myself, Mike, and this other partner on this flip. And that was the first project that we collaborated on. And that was 2017.
Yeah, so I was still working actively as a plumber. Mm-hmm. And I was just getting my realtor license. Because what happened was I was planning on leaving, my full-time job as a plumber and figured, how am I going to substitute my income? What am I going to do day to day? The portfolio probably would have been able to substitute it, but then what does my day to day look like? So I said, let me get my realtor license. And the mutual friend that Mark's talking about, you guys were off doing flips. I said, let's add a flip into the mix. So I can be a realtor, have a flip, and leave kind of very seamless out of my job. And got into one that was a bit of a flip project and started working together ever since.
Awesome. I noticed that you have had some listings in Hamilton. How did you get in that market? Do you invest? Is that like your primary market?
Yeah. So I started off, I believe, 2010 was the first triplex I bought in Barrie, and built that portfolio of about 40 units in Barrie. 2012, I transitioned into Hamilton. and bought, I think it was a triplex with a fourth unit for $240,000 back then.
Nice.
And had a couple of,
240.
Yeah.
It's like the rental
think
budget
about it.
now.
Yeah. Even the 12 unit I bought in 14 at 700 and change for a 12 unit building back then. But yeah, 2012 started investing in there. And then, friends of friends just asking me, oh, I seen you've done well. Where should we be parking our money? Can you help us out? And really started focusing in the Hamilton area.
Yeah.
Yeah, and just that's kind of how I moved into Hamilton, and that's been the primary spot where I've been investing.
Yeah. So what are you guys focusing on now? Like, are you guys still working together on multis, or has your strategy changed at all?
Yeah, so I mean, we've built the brand, Peak Multifamily, which is really focusing on commercial multifamily. We're essentially a boutique private equity real estate firm, right? So we're the operators. We find properties. We operate, whatever that means. Sometimes it's renovations, the property managing the asset, and work with accredited investors that want to add commercial real estate, specifically multifamily, to their portfolio, given the risk profile, and they invest with us, and we manage the asset for them.
When did you start doing this? Because I know, like, even when I met you, you were basically just flipping at that point. You kind of just started dabbling with this a little bit.
2018 was the first kind of we collaborated on a 14 unit.
Yeah.
Yeah.
Okay, cool.
Yeah.
And how's that going for you so far? Like, raising capital and working with accredited investors and all that?
Yeah, I mean, I think it's, I think when you start off, it's like anything, you have to have a brand, you have to have a track record. I think we're at the point now where, I think the challenge is finding enough inventory to kind of keep up with some of this investor demand. So it's a good problem to have. And yeah, I mean, I think it's brand, reputation, people I think people look for a track record. The first one's always the hardest one, right? Because like you haven't proven yourself yet, really.
Yeah.
And then I think once that goes and you've shown that you've been able to generate, what you said you're going to generate, you've hit the pro forma or exceeded it. That helps
for sure.
And, and then also, from the flips, or a lot of investors that invested with me on the flips that kind of, had some success there with me. It was an easier conversation for them or with them to come into multifamily. And now, the stuff that we're doing, the education, the content, the podcasts all help as well. Just kind of showcase our expertise.
For sure. Mike, you seems like you own quite a bit of real estate. You probably have some decent cash flow. Why is it that you're still interested in growing and moving forward?
You know what? Cash flow is not really there. We buy a lot of value add properties, and they're running negative, severely negative.
Yeah.
We're still looking at growing. Why? I think I'm not yet ready to kind of retire. Still want to stay active, and what we're pretty much doing is refinancing, recycling that capital, and buying more.
Yeah.
Right. And sometimes when you're leveraging a little bit higher than you should. And when I say should, I mean to get into another property rather than getting, a second on a property. You just leverage that one to, its highest LTV. Until I hit that I guess net worth that I'm comfortable with, and I'm sure that'll always be a changing target.
Yeah. So you mentioned buying these value add properties. They're the negative cash flow to start. How do you manage that? How do you maneuver through that to make sure you're not putting yourself, you're over leveraged, or you're putting yourself in a dangerous situation?
We're typically raising for that. So when we're doing our underwriting and kind of looking at the pro forma, we're factoring in what our monthly expenses are, what type of rentals we plan to do, and we'll raise for that negative.
Yeah.
We'll have, say if it's a 2-year refi, we'll have our net operating income at the end of 2 years projected, know what we're going to refi out, and take it from there. But it's typically raised at the beginning.
Yeah.
Yeah, and I think that, it's not a surprise that it's negative. We know it's negative. We know typically how long, within a few months, how long it's going to run negative. And it's purposeful, right? Yeah. So we know, again, the value add strategy, for those that don't know, it's you're buying assets that are underperforming financially, right? They're not doing what they should do. And so we're taking that on. It's like buying a poor performing business.
Yeah.
You buy it, you instill perhaps new management, new systems, you turn it around. That takes time, right? So 18 months, 24 months. But we know going in that this thing is going to bleed for a little bit until we, turn it around. And so, like Mike said, you plan for that. You know it's going to be negative, whatever that is per month, and you just make sure that you have the capital to support that.
I just wanted to jump in. This what you asked me about cash flow earlier. That's always the struggle. So, just for an example, we bought a building at $3 million beginning of 2021, renovated it, probably worth about $7 million today. A lot of equity in there. So the question is, do we not refi it and cash flow like crazy and leave, $3-4 million in the project, or do you leverage it with a lender that will allow a second on top potentially, so cash flows break even, but now you're pulling out, $2-3 million to go off and invest in another project or two other projects, and where is that healthy balance, right? Me as an active realtor, a lot of my income's coming from there. So I don't really need the cash flow today.
Yeah.
But I'm really starting to think, if I do want to stop working as an agent or, actively working, maybe we should leave some equity. And we have this discussion. Are we ready? Are we not? What do we want to do? Like, how many years before you start traveling, 3, 4, 5 months out of the year and your active income sort of drops? But it's always a floating target in a conversation, right?
Yeah.
So it's exciting.
Yeah, for sure. The way things are right now, the market's so hot that people like multi-units are obviously increasing quite a bit in value, and sometimes you might not have the income from the building to support the price. In that situation, does that drive you away from these homes, or are you from these properties, or are you guys still going after them because of the value add opportunity? And if so, how are you making sense of these deals?
We could probably have a couple of takes on it. So, just one that we went after this week, the purchase price, it just wouldn't allow us to do what we need to do, right? Someone else bought it. It fits their model. I think you have to scrutinize a little bit more, right? I think not every deal works, at least I think everyone has a different model. We have our own model. We have certain thresholds that we need to hit from an ROI perspective to make the deal work. The pricing is getting up there in such a way that some deals don't make sense anymore. And I think what's important for anybody, just like in residential and commercial, you have to have your number, right? What number are you not going to go above? Because as much as commercial is less emotional probably than residential, you still kind of want to get that deal done. But you have to have a number. At some point the deal doesn't make sense anymore, and so you have to drop it, or that's kind of your max offer. But I think the thing that we've learned over the last bunch of years, and we help people as well understand from a coaching perspective, is that there's a lot of things you can do with financing to make the deal work, to get it done. Yeah, maybe it's a little more leverage, but in the end, your ROI is still going to work out. Again, you have to be comfortable with that strategy. There's a bunch of different things you can do. But yeah, pricing like anything is becomes an issue.
Yeah, for sure. Now, if you're getting into a building where the rents are really low, and obviously the strategy is to turn over these units, what are some of the things that you've been able to do to successfully complete that process? Turning over the units and removing the tenants and whatever. Yeah.
So I think in Ontario, right? the landlord tenant laws don't allow you just to evict someone, right? N13s, you can use that. We typically don't use that, or we haven't used that actually. That form of that strategy. I think a couple of things happen. It is a risk factor, right? Because turnovers, the number of units you turn over factors into your ROI, and you can make a building look really good on paper by saying you're going to turn over 100 units.
Yeah.
How realistic is that? I don't know. It depends on the building. Depends on what your finances are. In a renovation, people don't like living in renovations or areas or buildings that get renovated, noise, dust, and such. So you'll have some natural turnover. A lot of times you go into these buildings and people have thought about moving. They just need a little bit of extra help, sometimes financially. Maybe they need help moving. Maybe they just haven't been able to find a place so we can assist. So there's ways to help people kind of achieve what they want to achieve a little bit faster than they may do on their own. But it's a number, like the turnover rate is a number that is not guaranteed. You don't really know that. You have a guess. I think based on when we walk through a building, we look at the tenant, the age of the tenants, the profile. You kind of have an idea. Okay, maybe 50% will be able to kind of move out, or maybe it's less, who knows, right? So it is something that you need to really pay close attention to.
For sure. So Mike, what areas, because you're not only an investor but also a realtor, so what areas are you finding are providing some good opportunities for investors that are looking at for multi-unit properties?
Me personally, I like the tertiary markets, anything outside of Toronto. I think you're just getting a better bang for your buck. Like we're in Barrie, we have a couple of buildings in Barrie, and the average market rent in Barrie I think is higher than Toronto across the board. But you're going to pay a higher cap rate than you would in Toronto, right? Same thing in Hamilton. I mean, you're pretty well versed in Hamilton market. You're getting a better bang for your buck, and I think our 2 bedrooms we're pushing like $1,950 to $2,000 a month now.
Crazy.
With the rentals that we're doing.
Yeah.
So personally, I like just outside the main core city. But there's also some analysis you have to do to make sure that city's right. Is there GDP growth? Is there population growth? Is there, that demand there for that city to continue to grow?
Yeah.
But yeah, I personally have always liked outside. Having said that, when you start working as an agent with some clients and bigger players who are building a portfolio faster than most, and you're not finding the inventory, you start to move into, the Toronto markets. Just more inventory there. Yeah, you're paying a lot more, but you look at some of the bigger REITs, they all have buildings in these big major markets. Why? Right? And that's that question. How big of a portfolio can you build in these tertiary markets?
Yeah.
Right? And I think if you're staying, under 1,000 units or so, it should be easy to do. But once you kind of excel past that 1,000, getting 5,000, 10,000 units, you do start looking into those more stable markets.
For sure.
Right? I actually wanted to touch base on the last question you asked about getting tenants out. One of the things that a lot of investors don't look at is the rate in which rents are growing. So, for example, if you're buying at a 3.5 cap, and you can't get tenants out, but the rents are growing at 5% per year on average. Hamilton's seen rent growth of 10% for multiple consecutive years. That cap rate drives down, right? So now, say your average rent's 1,000 and market's 15, and you're buying it at a 3.5 cap. When that market rent goes to 2,000 and your average rents are still 1,000, someone's going to pay 2.75 cap or 2.65 cap, which is going to drive your value up regardless of turnover. Right. So a lot of people will look and say, I don't think I can turn over that many units. But where is that rent headed? And how far down is it going to drive that cap rate? Right. So that's something else to consider when people are looking at turnover. Right. We have a building that's probably made in 24 months, probably made 100%. We've had 1 out of 12 units turnover.
Yeah, right. That's pretty crazy when you think about it. But I guess it's just the way it is. Like there aren't that many apartment buildings available for sale, so people are willing to overspend a little bit just because of that potential. Even though fundamentally, if you read certain books, you read certain theory, they say you should never evaluate a building on potential. But if the market is the way it is, you kind of have to some extent, right?
Yeah, and I think obviously there's some speculation, and as a sophisticated investor, do you want to be looking at speculation? Is it speculation to some? I mean, it's all how you take it, right? If your goal is to buy, in a couple of hours from where you live, and you're not comfortable investing in another country or another province, you're not going to buy if you're not paying these prices. And if you're in it for, and understand the real estate cycles, but you're in it for 10, 15, 20 years, does it really matter if you're overpaying $100,000, $200,000 today? It starts to get tough when you have 5-year capital, and now you have to project and give a return to your investors within a 5-year period. Will there be some hiccups where there'll be lower returns? Potentially. But, I'm at the age where I'm going to be investing for 20, 30, 40 more years.
Yeah.
Everyone's talking about capital gains tax changing and things like that. Okay, I'm going to get hit with that anyways. Right?
Yeah.
What am I going to do? Stop buying?
Yeah.
So it's all, I guess, the mindset and the time you're at in your investing career, and also the capital. Is it 5-year money, 10-year money, and so on, right? And sometimes, like when I'm going up against someone else, and I know they're in there, like in an offer presentation, stuff like that, I'm saying to myself, shit. these guys are holding for 20 plus years. Their capital partners are long term. I can't compete with it, right? So sometimes I'll back off because it's like I can't pay what they're paying.
Yeah,
I know what they're doing. I know their strategy.
Yeah,
right. So I mean, it all depends.
Yeah. A little bit earlier, you were talking about the renovations that you guys are completing are driving up, or are allowing you to get really high rents. What are some of the renovations like? What kind of product are you putting into your units? I think that's probably more what you do because you used to flip. I don't know.
Luxury vinyl flooring, right?
What are you paying for your flooring? Like $3 a foot or something?
Yeah, so I think it's like $350 or so. So it's it's glue down, so it's like 5 millimeter.
Okay.
So it's comfortable. It's cozy on the feet.
Yeah.
Super durable, right? And then it's like $1 something to install, right? So it's not cheap, right? It's not cheap stuff. Paint stuff, that kind of stuff.
Why is it? Sorry, just to kind of go back. Why are you doing the glue down stuff?
Okay, so we're actually going to click now in certain units.
Yeah.
So glue down works on concrete because there's no shifting.
Yeah.
Right. So again, kind of through trial and error, we've used glue down on wood. Right, and that shifts, right, because as kind of the floors, contract and such, right. So we now learned that let's kind of put float and click on those floors. So and then on concrete, it makes sense to kind of keep the glue down. The benefit of glue down is that if something were to happen to one plank in the middle of the floor, you can take out that one and then replace that one versus having to redo kind of everything to the wall, pretty much, right. So from a maintenance standpoint, it's a little bit easier. But what we found is on wood subflooring, the gaps start appearing pretty quickly, especially during change of season.
Yeah. Okay. So vinyl plank now.
Yep. New kitchen. Paint. Trim. Those are the basic stuff. New bathrooms, right? So basic bathrooms.
What are you spending per unit?
So costs have been going up, right? Yeah. So about $40,000 for the ones.
And this is like rewiring the unit, new plumbing, all that.
Yep. Yeah. Typically, you don't have to run new plumbing unless it's you're adding laundry and the laundry stacks.
Maybe not run new plumbing, but I mean, just like
new fixtures.
Updating.
Yeah, all new fixtures. Yeah. Electrical, the panels get swapped out, right? So in these older buildings, it's kind of the fuses, so we change those to breakers.
Yeah.
Typically 60 amp, 70 amp. What else? Ductless AC systems.
Oh, cool.
Right, so those have gone up a little bit in price too.
Yep.
Also, they're heat pumps as well. So they also provide secondary heat. I don't know how many tenants actually use it for heat, but
why are you using the ductless AC system? Is that because it's kind of reducing your ongoing costs? Like, does it run on hydro and then the tenants taking on that cost?
So the tenants take on that cost because most of the units we have are individually metered for hydro.
Yeah.
I think it's just a nicer looking kind of unit. It's a nicer looking unit versus having something hang out the window, right? So I can get a little bit more of that luxury feel.
Yeah.
What else? So the kitchens, of course, new kitchens, new cabinetry. It's quartz counters, right, versus a laminate. So I think that adds a little bit of a luxury feel. What else are we doing? Oh, in-suite laundry as well.
Yeah.
Right, so stainless steel appliances. So, it's a self-sufficient unit, right? You don't have to use the common area laundry, and so that's getting top of market rents.
Cool. I just want to go back to that AC thing. Does that also heat the unit, or are you guys paying? Like, do you have gas, or typically, or do you have some sort of like furnace that you're paying for, or what?
Yeah, so all the buildings run on a boiler system, kind of natural gas run boiler system. So that's the primary heat, and then those heat pumps can act as secondary heat sources. Although I don't know how many people actually use it for heat.
Okay, so you guys are covering the gas in the building, but again, the AC unit that you're using, they're paying for it because it's going through hydro.
Yep.
Are there any ways that you guys have been able to reduce your ongoing expenses in terms of utility costs, that sort of thing, that you've had success with?
I mean, we've looked at what's it called, water metering. It hasn't really made sense for the buildings that we have because you have to add in, 2 meters makes sense, but some of the units require 4 meters, sometimes 6 meters. So just the cost of that doesn't really make sense. It doesn't offset the savings. LED lighting, we're putting LED lighting in most of the common areas or all the common areas and outside, right? So kind of the exterior lighting. Those are kind of the big things that we're doing in addition to the units, right? So the units, all the new appliances are much more energy efficient than what was there before, right? And then LED lighting in the units too.
Awesome. What was there?
I just want to get back to those heat pumps. I think, don't quote me on this, but I think if you have a high enough BTU rating, so some of those ductless ACs are 12, some of them are 24, you can put multiple heads, and then it could be used as a primary heat source. Right, meaning if you put 2 or 3 heads, depending on your square footage and the BTU coverages there, you could practically shut your boiler down.
Right.
You just have to do all the units, because if you've done 60% of the units, how are the other tenants getting their heat?
Yeah, for sure.
Right, and some other things. I don't think we've done it, but when majority of the building does have the heat pump and it's used as a secondary heating source, you could tone your boiler down a little bit. It doesn't need to be as hot and put the cost on them. Yeah, just another tip, something to think about.
If you did put like 2 heads on the AC unit, would you need a 100 amp panel, sub panel in each unit, or it would still go on the 60?
Yeah, I think it still goes on the 60.
Yeah. Okay. Yeah. Cool.
Yeah, because we have one building in Hamilton where some of the units, actually the one unit has 3 heads, so we have 1 head in the main room, and then 1 in each of the 2 bedrooms. And the panels not 100. It's
60.
Yeah.
It's 60, okay. So in that particular situation, you have 3 of those ductless units in the 1 unit.
That's right.
Yeah, in the 1 rental unit.
Yeah.
Okay.
Positioning is very important with those units.
Yeah.
So if you have, a standard 2-bedroom with a hallway and then the bedrooms down at the end of the hallway, if you don't have that ductless AC head kind of pointing from your living room through into that hallway, you're never going to get any cooling down there at all.
Yeah.
So tenants start to say, well, we sleep at night, we're hot. Can we install another AC unit? Can we put a window AC unit? And that's what we're trying to avoid, that look on the exterior of all these window ACs.
Yeah.
So depending on the positioning, you got to be careful, because you will have tenants start complaining, and then you have to add a head and do construction at that point. So something to consider when you're putting them in. And
what are you usually spending per head? Is it? I think I've looked into it at one point. It was roughly like $2,000, $2,500, something like that.
It's quite a bit more now. Some of the contractors are about $5,500 to $6,000. I think we're getting them all in now for about $4,300.
$4,300 per head.
Per head.
Jeez.
Right,
so is it worth it? Is it worth it?
If you put a second head, it's cheaper, because that's everything condensing unit outside, and then the 1 head inside. Do you know how much, Mark, for additional head?
So I think it's like 3. Well, one we were quoted like $2,500 to $3,000 for an additional head.
Okay. Yeah. Okay. Yeah. I guess you'd have to run your numbers and see if it makes sense to do that.
Yeah.
But again, if you're looking for a certain look and you don't want those AC units hanging out of the window, then it makes sense. Yeah. Sorry, were you going to say something?
No, go ahead.
I was just going to say, any other tips for investors that are in the multi-unit space, ways that they can maybe offset some of their costs, or successful ways that you've had maybe with plumbing or something like that to reduce your water bill?
Plumbing, even just, I think in one in Barrie, we replaced the aerators.
That's it.
So low flow plumbing fixtures, aerators on faucets, LED lighting, just standard stuff, right? But at the end of the day, what I think you have to look at is, you put AC in a unit. Okay, it's going to get you a little bit more in rent, slightly more in rent. But when you're putting everything in there, you're putting the stone countertops, you're putting the AC units, the in-suite washer and dryer, stainless steel appliances, and you're comparing it to like condo-style units at a discount. Yeah, you don't have the amenities, and that's why it's discounted. You're going to get those premiums.
Yeah.
So I think you have to look at, if you were only to spend $20, what would your rent actually look like? And when you go into, Rent Cafe, Pad Mapper, and all the rental sites, you'll start to see that, guys that are doing $20,000 type rentals are getting $200 a month less, $150.
Yeah.
And when you're looking at it from a cap rate standpoint, it's like, spend the other $20, have it like, condo grade, and get that premium in rent. You're also going to get a better tenant profile.
Yeah.
Right? You're going to attract that. So, I think you have to look at everything as a whole. and then see if your budget and the capital you have allows you to do that.
Yeah.
I think it was Wise Meter who we spoke to, and the sub metering, and in a lot of condos that were built and or apartments that we're buying, you typically have your hot and cold risers run for all the washrooms all the way up. The washrooms are set in the same spot.
Yeah.
So hot and cold lines run up. Kitchens, same thing, same spot. Hot and cold lines run up. And then if you're adding your washer dryer to, a closet in the center of the unit and running a new stack, you're going to have another hot and cold line run up. So essentially you would need 6 meters. One on the hot, one on the cold for your kitchens, your bathrooms, and your laundry.
Yeah.
Where some of the buildings, actually it's only one of the buildings that we have, they have their own hot water tank in the unit. So what happens is a cold line comes into that hot water tank. That's where you'd put the meter. Then off that hot water tank, you have a hot and cold line which feed the whole unit.
Yeah.
So in that particular building, it would probably make sense. But I think what you have to factor too is if someone's paying $2,000 for a 2-bedroom unit all in, and that's kind of the market, $2,000, whether it's 1950 plus hydro, when you start adding all these utilities to the tenant, does their base rate decline? Right? So what are you really getting by putting water on them? They're going to say, 1,900 plus water and hydro, and you might have to discount it to 1875.
Yeah.
Right? Because now it's getting out. They're uncertain. So we typically just stick to hydro.
Yeah.
We'll separately meter hydro because that's kind of common. That's the norm, what people see. And I don't think sub-metering water in a lot of cases will make sense. So we've just kind of avoided it.
Yeah. I guess the only benefit would be that people would be more careful about their usage if they know they're paying for it. I'm sure you guys have seen situations where you're paying for all the utilities and they're leaving the windows open in the middle of winter because they don't care.
Yeah.
But yeah. And another thing you mentioned, Wise Meter. So I would be careful. I did a bit of research on them and I just Googled them and they have a lot of really, really bad reviews. And not that you might think as an investor, I don't care. Most of the reviews were from tenants saying that Wise Meter basically charged them for something and then they tried to contact them to reverse the payment because it was a mistake and they just never heard from them. And as an investor, I don't want my tenants to have that kind of negative experience, right? So it's just something to keep in mind. Anyway,
it creates headaches, right? Creates another ticket for property management.
Yeah.
It's I haven't heard that. Again, we don't have them in there. We didn't go so far to kind of investigate further because we figured just financially didn't really boost the ROI so much, but that's good to know.
Yeah, it's just good to I think it's just important if you're going to sign up for a service like that, just Google it and make sure that your tenants aren't going to get stuck with a situation like that.
Good old Google research.
Yeah, exactly. Okay, so how are you guys finding deals these days?
Building relationships. Spent a lot of time building relationships with brokers in the space, and a lot of the brokers that I've built relationships with, they're typically you go on the MLS, you don't see a lot of buildings.
Yeah.
A lot of building owners go to these particular brokers because they have large databases been selling buildings, and they go out exclusively to, I don't even want to say their database, some do, but some go out to a handful of reputable buyers that they know can close.
Yeah.
Right? So I would say majority of our buildings, outside of one, which was direct to seller, have come through building relationships and trust with these brokers, which takes time. I think the first 2 years I started doing it, I don't think I even got a deal done.
Yeah.
Right? And that's what I tell a lot of people is it's consistency. Just stay consistent, pick up the phone, and be transparent. Right? We put an offer in yesterday on a building that I pretty much told the broker that, listen, it's not going to work for us. The price isn't right. I'm not submitting. And I told him why. We have our eye on another building. We're not able to buy them both right now. And he said, submit anyways. He's like, just do me the favor, submit. Now, he works on a team, so I don't know if he wanted to bring in an offer from his side, whatever it was. But we ended up submitting. We came in a little light, which we knew we would. But now it's kind of, I did him somewhat of a favor. I'm hoping in the future he does me a favor, gives me a kind of exclusive. Yeah. And it's just that consistency of working with these guys and, having the relationship and transparency. And then there's the, direct to seller. Some of the campaigns, the direct calling, the mailers, things like that.
Yeah. Awesome. Okay, cool. Was there anything you guys feel like would be important to share before we wrap things up, or did we cover most of the stuff that you usually talk about?
I think one of the other things, if someone's getting into the space for the first time, like, from single family into commercial, and we encourage, people to really make sure they're working with people that have done deals, right? Or experience, whether it's a realtor or mortgage broker, legal, the deals are fairly similar, but I think there are nuances definitely with commercial that you want the right people on your team. I mean, there's so many examples of, residential investors that use the same broker. In commercial, it's different, right? Like, things get valued differently. How to set up the financing really matters in any real estate deal, and specifically, commercial. So I think just and it's hard for people if they have a relationship with a residential real estate agent or mortgage broker or whatever other professional for years. It's hard to have that conversation. Hey, I'm going to use someone else for commercial, but at the end of the day, like, you have to look out for your own business, and it's really important to have experts, right? And that's one, I think, a pitfall and a hard conversation that people do have to have when kind of starting to shift over.
Yeah. 100%. Mike, anything else?
I'll just stay on that track of having, a multifamily focused team, right, where everyone's primarily in multifamily, is that mortgage rules and lending and loan to values with different lenders, it's constantly changing. So a lot of times people have conventional, they're starting off, this deal doesn't make sense. If you're staying on top of things, and we just did a webinar with Ed from First National, and they have that new MLI Select program, which allows you to potentially get 95% loan to value and a 50-year amortization. That, in some cases, changes the game. Stuff we looked at a year ago that didn't work would work right now because of that.
Yeah.
Right? So if you're not keeping up to date with the financing game and strategy and structure, it's going to be hard for you to buy.
50-year AM?
Potentially.
95% loan to value?
Yes.
Wow. That's
came out
crazy.
March 7th. What are we? March?
This week.
Yeah.
Yeah, 2 days ago.
Monday.
Yeah. Wow.
So,
crazy.
Now, there's certain criteria. You might need, affordable housing or accessibility or some efficiency.
Yeah.
But, I mean, if you don't know about that, you're not going to look into it, and the deal might not work.
Right.
So now even some of the properties that we were thinking about maybe selling because they're complete or, buying off our partners or whatnot, now we're re-looking at everything saying, what can we do here? This is fantastic.
Yeah.
Right? So just staying up to date with what's going on because it's forever changing.
Yeah, for sure. Okay, so to finish things off, how do people reach you guys, and what services do you provide?
So, I mean, we're on social, so like LinkedIn, Instagram, Facebook. We do have a Facebook group, a private Facebook group. The Apartment Building Investors Network, our website, peakmultifamily.ca. We have a podcast, the Canadian Multifamily Investing Podcast, which is just about commercial real estate or multifamily real estate. So we're not hard to find.
Cool.
Yeah.
Anything to add, Mike, or that's good?
We do offer a coaching program. So if people are looking to get started in multifamily and looking for some guidance, we do deal analysis, like on a per hour type basis. So if someone's not confident, it needs another set of eyes from guys in the space doing it. We do offer that, and that's on our website as well.
Awesome. Okay, thanks, guys. I really appreciate you coming out. I know you're both busy, and it's great connecting with you two.
Yeah, thank you.
Great
conversation.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.